Hi guys, and welcome to the first video session on time value of money. So we are in quantitative methods, and this is the first study session and the first reading of the entire CFA syllabus for the May 2022 attempt, which most likely would also cover almost the same LOSs and the syllabus for even the attempts, probably two attempts after that, right? Now, time value of money is a section which is the basis of the foundation for finance, I would say, because most of the calculations which you will learn out here will form the base of calculations even for topics like fixed income, even for topics like equity valuation, and even for some sections, you will realize that it also comes in handy in derivatives, right? So, not a very difficult reading, I would say, the first reading, if you tend to get a perspective, right? Now, the only issue with this reading is that what I've seen in most of the content which is published on CFA, whether it's the original curriculum or whether it's the derived curriculum, right? That a lot of focus is on equations and formulas, which I feel is unnecessary because the concept and reality is actually very simple, right? So let's get started by just looking at first, what are the areas of coverage of this entire reading, and then we can get into specific topics. So let's start with what does the learning outcome statement of this entire reading expects us to know. You have to be very careful with what they write out here because you don't want to over prepare, and at the same time you don't want to really under prepare, right? So we will see that we're going to be talking about the interest rates, which generally we talk about rate, and what is its different application and the understanding of what rates are, what is the you can say, what does interest rates in general include as a part of its application, right? We also get into calculations of stated versus quoted rates, which you'll understand in a practical. I'll try to make this as practical as possible so that you get a perspective of how it actually gets used in the industry. Then there are these calculations. Okay, so I felt that these three readings, these three LOSs are finally are related to calculations, which are very easy. Okay, and the only issue is that they start discussing interest rates out here, and then they get into some theory out here, right? So what I'm going to do is I'm going to take the first LOS and quickly finish off D, E, and F also through one simple example, right? So what we're going to do is, of course, I have a very ready-made notes which are made here, which you get as a part of enrolling with Mentor Make Careers in the CFA program. These are very concise notes, but we're going to stick to also some whiteboard calculations because it just becomes very easy to make you understand what are we talking about, right? So let's start talking about what are interest rates. Okay, so I'm just going to quickly switch into my Blackboard. Okay, so we're back in my Blackboard. It's just becomes very easy to explain the entire concept very fast, right? So, at one end, we're talking about rates as a whole concept, right? Now, just look at it from an industry angle. There are various ways by which we try to use the definition of rates, right? For example, the first one would be just interest rates, right? You go to a bank and ask, you want a mortgage, you want to buy a house. So the bank says that, you know what, we're going to charge you about 7%, right? You go to equity markets, right? So in equity markets, you go and you say, what should be the returns expected in a mutual fund. So if you say that it's an equity mutual fund, then let's say, okay, I'm expecting about 15%, right? Then you talk about businesses at the other hand, right? So businesses, whether to start a business or not to start a business is also somewhere related to returns. So you would say that, okay, what is the expectation or what would be my returns if I run this business for 5 years, right? So let's say someone says that, okay, you know what, 22% is my expectation. So in reality, if you see, the definition of rate can be, something like on a fixed income product. In CFA curriculum, whenever you're talking about debt related products, you generally call it as fixed income, right? So it could be related to fixed instruments. It could be related to, stocks. It could also be related to business. Now, That means that we are basically saying that the interest rate could also be called as, a bank rate, right? We could also call it as, if you're talking about equity markets, then we could also call it as minimum required rate of return, right? Because you will not invest in mutual fund unless and until you have some expectation of uh, a certain amount of return that you're willing to take the risk for, right? And finally, the business, which you could call it as opportunity cost, right? Now, if you see, mostly in the second definition, if this is the first, this is the third, and this is the third definition of what rate is, there's not much difference between these two, right? Because if I'm presented with mutual fund A and mutual fund B, and let's say I was already invested in mutual fund A and I was making, let's say, 12% return, right? And somebody presented with me with a new product on mutual fund and says that, you know what, I'm going to give you 15%, then probably my decision would be just on the basis of this fact that, okay, let me consider it because I'm getting more than what I'm already earning, which is 12%, right? So this becomes a very easy example of opportunity cost, right? Now, in finance, what exactly happens is we also talk about something called as the cost of equity, right? Which is if a business is running, right? So if let's say we are talking about business A, okay? Now, business obviously gets funded using debt and with equity, right? Now, even this capital which the business has, finally somebody has funded it, right? So you might say that, okay, you know what, debt is available at 13% and the cost of equity, this is, in a business sense, becomes a little difficult to estimate directly because there are so many investors and you can't really go and ask each and every investor, what is the minimum rate of return, what is the minimum rate of return. So what you usually do is you use something called as the CAPM formula, which we will get into sometime. But what it entails is just minimum required of return, which is a combination of what is the risk free rate of return and what is the premium or the risk premium to invest in this company, right? So that takes care of our understanding of what are the different definitions of rate. So you should not always take it at face values, thinking that, what, rate only means uh, interest rates. Okay, it can mean multiple things, which we just covered. Now, another topic that we want to talk about is, then if we are talking about risk, right? So we understood what is the definition of interest rate, but let's also understand how does finally this translate into risk, right? Because if somebody says to you that, what, we will pay you we will pay you 10,000 and then you will get 9,000, probably you will not agree to this, right? Because your value of money is finally dropping down, right? So this is not acceptable. But if you look at the other proposition, which is you pay 9,000 today, you take 9,000 today, and then you receive 10,000 in 1 year, then that looks like a offer that you want to consider, right? Now, why would you do? Because you understand that over time, right, if you do not do anything, your value of capital is going to keep on decreasing because there is an acting force on this, which is nothing called as inflation in general, right? Because the purchasing power of your capital is decreasing year on year. So if you want to counter that so that you have the same purchasing power or even more purchasing power, you will have to sacrifice something. And the sacrifice is current consumption. I mean, you could always just uh, take this 9,000 or 10,000 and just consume it and story's over. But you delay consumption so that you are able to have more purchasing power in the future, right? So that's one concept. And in the process, finally, of taking that consumption or delaying that consumption, you are basically taking risk, right? Now, the reason why I'm talking so much initially is because You need to understand time value of money, not just from a formula perspective, but also from the perspective of risk and decision making and behavior, right? In general, we as human beings are risk averse, right? Now, people generally think that risk aversion, in the general sense, think that no, that's not how it is. I would confidently say, as a CFA charter holder and also a fund manager previously, I am also a risk averse person, right? Because I will not take risk. This does not mean that I deny risk. This does not mean that I will ever say that, you know what, I'm not going to take risk. But all that risk aversion means is that you need something in return, okay? Something that compensates for this, uncomfortable decision, right? So to put things into perspective, if you are investing in equity markets in India, right? Uh, the uncomfortableness right now probably you might not feel because the markets are going up, but in general, the markets tend to go down at least 60%. So this is a pretty uncomfortable situation to experience, but you get compensated for this by giving you almost 16 to 17% return in the long run in a 10-year time frame, right? So you see how the trade-off between risk and return happens, right? Now, if we understood that, then we will understand what are we finally getting compensated for, right? So let's see what we're getting compensated for. So you are getting compensated for default. I'm going to come to risk free rate and inflation premium in a while, but let's understand what we're getting compensated for. So not just risk, but we can define risk in terms of volatility also, plus the risk of the company shutting down, or maybe the company not sticking to its terms when they sold us the asset at the first place, right? So you're getting compensated for the possibility of a default. You're getting compensated for the fact that you might not be able to sell your asset that you purchased initially for returns, and you're also getting compensated for waiting for a long time for the asset to mature, right? Because a lot of things can happen up and down basis the time frame that you're investing, right? So this is the premium that anyone would expect, right? But over and above what should always be free, right? Because this should be free. Because even if I don't take any risk, if I don't take any uncomfortableness in my investing process, I could always go and buy a 10-year government bond, right? Now I am 100% sure that the 10-year government bond will be risk free from a perspective of thinking that the government really can't default, at least in India, because they can always print money, right? So I would want something above, let's say, 4%, because 4% is already free, let's say, right? Plus, let's say I'm saying that 3% is inflation. So, what's the point of just getting 4% when, let's say, the inflation is about 3%, right? So that means my 7%, I will talk only above 7%. So above 7%, then I will start putting some values on default, liquidity, and maturity. At least that's how the thinking is. Right? It's not necessary that in every investment you will go and start calculating this. It's not practical, right? But if you look at any return, if you want to decompose the return, stating that, okay, if equity markets are giving you 15%, then you have to understand that out of this, 4% was already free, which is risk free, right? And the rest of it, which is 11%, is the risk premium you're getting. But you also need to understand further that even if you are investing in a stock, let's say, right, or let's say a mutual fund, if the index itself is performing at, let's say, 12%, right, let's say Nifty 50, right, an index. So if it is giving you 12%, then you would ask the fund manager, what good are you doing beyond this? Right? So he's generating you basically the plus 3% after, let's say, transaction charges. So I don't want to really go more deeper than this at this stage because it's not required. But I'm just going to give you an idea. I'm trying to give you as much perspective as possible so that you don't have to memorize all of these, right? Now, An opinion on risk premium which I always talk about is the fact that we always say that higher risk, and that's actually how even I used to think, that higher the risk, the higher the return. But we have to be very careful with this. Okay, higher risk and high returns might not always be true. If you look at Indian equity markets, you will constantly see that the small cap indexes in general have not been even able to beat the large cap indexes, wherein the small cap indexes were supposed to actually generate you higher return because they were high risk. But unfortunately, if you look at this data, right, you can try to pause and actually look at this chart properly, you will realize that it has actually not ever happened. So why so? Right? So that's again a business answer to it, because a lot of larger companies in India have the power to capture the market, and availability of capital in India to smaller companies might still be limited, even though we have passed through various stages of development in India. Right? Now let's go to the next calculation of LOS of ENF, which is on compounding. Right? Now generally, CFA syllabus has CFA curriculum specifically has focused a lot on equations, but we're just going to look at what compounding is in an example. Okay, so if you see that if you're investing, let's say 1 lakh for 6 years at 2% rate of compounding, right? Let's try to understand what exactly happens in compounding, and that's how you'll understand the concept of interest on interest, right? So if you look at the first stage, right, you have 1 lakh out here, right, dollars at 2% for 6 years. So this 2% finally gives you another 2000, right? And the 1 lakh remains at just like how it is, right? At this stage, this is nothing but simple interest, right? But what happens further is that this 1 lakh again compounds at 2%, so that this 1 lakh and this 1 lakh stays the same. You see, no changes. But this 1 lakh again generates you one more 2000, right? In the second case, also the same thing is happening. See, this 2000 remains 2000 as it, but it generates you another 40. So if I look at the first period and the second period, you will see that two people were working for me. In the second compounding period, it just squares itself. So now we have four people working for me. And as you might have guessed, what would happen in the next stage would be, since four people are working, you would actually get 2 raised to cube, right? Then it will be 2 raised to 4, then 2 raised to 5, and so on. So that's the beauty of compounding, because as you keep on increasing the frequency of compounding, this will keep on increasing, this will keep on increasing, and so will the return. So if I have to conclude, the higher the frequency of compounding, right, higher the returns. It will increase till a certain level, and after that it will be constant, right? We'll get to that. But this is the idea of compounding. Why compounding is such a big deal in terms of investment, and why it's generally recommended that you compound, I mean, start compounding at a very early age. It's just because of this uh, ratio which keeps on working in the background for you, right? Now in the CFA curriculum, again, there's a whole discussion on the equation of future value and present value. I feel that it's very easy if you just observe the same example and you can actually derive the formula. It's not necessary for you to actually remember this, right? So let's get started with looking at the first example out here. So just observe what is exactly happening. So how did 1 lakh become 1 lakh 2000? That's what we need to observe, right? So we just need to observe how does this 1 lakh become 1 lakh 2000. That's how we'll get the formula. Okay. So if you see, the formula or the calculation that happened was 1 lakh into 2% plus 1 lakh. Now just notice this properly. This 1 lakh and this 1 lakh is common. And that's nothing but the value at 0. And this area is present because 0 is always present, which means today, right? So we could also replace these terms out here and just say that this is present value into 2% plus present value, right? And since we are talking about the value at year 1, right? So that means that's future. So let's just term this as future, right? So this is future. And the value we are getting out here is future value, right? That's all it is. So if we were to replace this equation and rewrite the equation, we could just write it as, okay, so we're getting 1,02,000, which is nothing but the future value, is equal to, we just wrote PV, which is nothing but the 100,000 that we're talking about. So 100,000. And we could just take it as common because it's repeating two times. So we can just take a bracket out here. We can take a bracket out here, 1 plus 2%. And out here, we can just replace even the 2% and just call it as rate R, right? And since it's compounded for one period, right? So we can just say that, okay, 1 means N, and out here it's just 1. There you go. You just derived the future value formula. Now, interlinkages is what is discussed in the CFA curriculum, but I think we can quickly do this in out here itself, at least the basics one. So if you just look at this equation out here, we are just saying that future value is equal to present value into 1 plus r raised to n. Now, just notice if I keep the PV to the right, or let's say I get the PV to the left, then I could rewrite this equation by just taking future value divided by 1 plus r raised to n. So that's my present value formula, right? Now, so this is the second derivation. Third derivation would be to say that, okay, let's try to rewrite again. So let's take the 1 plus r raised to n to this side, okay, and take the present value to this side. So future value divided by present value, right? Now, if I want to take n to the other side, so I can just say 1 plus r is equal to future value divided by present value raised to 1 over n. What would be the next step? The next step is simple. R, we're just going to take the 1 to the other side. Okay, so future value divided by present value raised to 1 over n minus 1. Right? So using these, calculating these functions in calculator is very easy. But if you're new to the calculators, but don't obsess on calculators, because in the original exams you might not actually find so many calculation intensive questions coming up, right? So the way to use the calculator is to first add the value which you want to find, right? Let's say you want to find out the uh, let's say you want to find out the future value of 1 lakh, right? So what you want to do is first add the value, right? So 1 lakh, and put a negative sign using this button out here, right? And then press PV. So then the calculator will take it as the present value. Make sure that it's negative, because whenever you're investing, the money is going out of your bank account, so it has to be negative. Then you press whatever the rate is. So let's say 2% is the rate, right? Make sure that you're not writing 2%, because the calculator takes 2 as 2% in case of the IY, right? So then you press I by Y, okay, which is nothing but the indication or symbol for interest. And after that, you put the number of years. So you just press 6 and then you press N, right? And whatever you want to compute, so you just press compute and then press FE and you should have the answer, right? So that's the way to calculate this in a calculator. Now let's look at an example out here. So if you're a lucky winner of your state's lottery for $5 million after taxes, you invest your winnings in a 5 year certificate deposit at a local financial institute. The CD promises to pay 7%. So the way to calculate any TVM functions is to first write down the data, right? So you are the lucky winner of 5 million after taxes. That means we're talking about today. So today is present value, right? And present value is nothing but at this stage we have 5 million, right? And you invest your winnings in a 5 year CD, which promises to pay 7% per year compounded annually. So my rate, or my I by Y, is nothing but 7%, right? The institution also lets you reinvest the interest at the rate for the duration of the seed, which is fine. So that means it's compounded, right? And we're talking about how many years? So we're talking about a 5 year period, right? So we're talking about N as 5. And apart from this, I don't think so we have any other information. So we can easily find the FP. Now, you can use calculator, but even if you do not use calculator, you can still find the answer. It's just to find out that the future value is present value into 1 plus r raised to n. So all you got to do is take the present value, which is 5, okay, 1 plus 7%, right, raised to 5. right? And that would be answer. So you can actually calculate, just take your time, calculate either in either ways, try to calculate this in the calculator as well as manually, and check if the answers actually match. Okay, now we are into time value of money problems, specifically when we are looking at bank interest rates. Right? Sometimes you go to a bank and you see that okay, the bank rate is 6.5 or whatever, 6.85, right? But is it really true? Because that's the concept of stated or quoted rates, right? So the bank is not responsible in telling you what is the compounding which is happening, right? Because all they do is this 6.5 has been derived in this manner, 0.54 multiplied by 12. That means the actual compounded interest rate you're paying is not actually 6.5, because this is just for the purpose of showing. But in reality, what is the interest rate? You again have to come back to the same concept of future value is equal to present value into 1 plus r raised to n. Again, the formula for calculating this in the CFA curriculum directly shows you this. But think of this as nothing but the future value formula, right? So if you look at the future value formula, uh, let me take PV as 1. Okay, so let's take PV as 1. So that would be 1 and 1 plus. Now we know that if I just divide 6.5 divided by 12 months, because it's compounding monthly, so we would get 0.54, right? So, or we could also write it as 6.5% divided by 12, because that's the compounding that is happening, right? Close it. And how many months are we going to compound this 1 rupee for? So, or $1 for? So 1.65 raised to 12. Okay, so in case you were not able to see, I'll just rewrite this equation out here. 1 divided by 1 plus 6.5% divided by 12 raised to 12. Okay, now you will see that in the EAR formula, there's -1. I'll tell you why it is happening. Okay, because if I've solved for this equation, what I've done is I'm actually trying to find out the future value of 1. So this answer is going to tell me what is the future value of 1. So if I want to remove the effect of that 1 present value, then what I got to do is do -1. So that will get rid of this 1 and I will finally get only the rate, right? So you can clearly see if I do 1 plus 0.54% raised to 12 minus 1, the actual rate that comes up to me is 6.67 and not the quoted rate of 6.5. Now, this is called as the effective annual rate. All right. So that's the concept. All right. So do not again try to remember this formula, because it's actually no point doing this, because it's nothing but the future value formula itself. Right. Next question is that, remember in the first section we discussed on as we keep on increasing the frequency of compounding, the returns tend to increase. But what if somebody says that it's infinite compounding that happens, right? So in case of infinite compounding, you can try it out. You try to compound the same 6.5% for annual, then you do half, then you do quarterly, that is 4 times, right? This is once, this is twice, this is 4, this is 12, right? This is, let's say, about 240, and so on. And if you try, you will realize that yes, your future value is increasing, right? But if somebody says that it happens continuously, how do you find out? So whenever you are saying continuously, that means you are talking about exponential, right? So if something is exponential, there's a function of exponential in in mathematics, which you can use using a function of exponent. So all you got to do is whatever my rate is, right? Let's say even if it's 2% is my rate, and let's say I'm doing it for 2 years, right? So this has to happen at an exponential level. Try to understand it this way, right? So what I'm going to do is I'm going to find the exponential of 2% into 2 years, and then just multiply that with the PV. That's all. So it's actually the same thing. Future value is equal to present value into 1 plus r raised to n was my original formula. But since we are talking about continuous compounding, all I'm going to do is just replace this with stating that, okay, you know what, same formula, but in case of the interior of the formula, let's just find the exponential of r and n. And that, if you just multiply, you will get continuous compounding. So that's the maximum that could actually happen. How do you do this in the calculator? Simply first you need to find out the exponential, right? Do not try to find out, do not try to do both the things at once, right? So if let's say if let's say my rate that I'm talking about is 8%, so I'll just multiply 8% with 2 years first. So 8% multiplied by 2, you get the answer. Then you will see that you can just press second, which is nothing but shift in your calculator, and press the exponential function, which is on log normal. So once you do that, you will get this value 1.17, which you can multiply it with 10,000, and then you have 10,000 increasing exponentially or continuous compounding for 2 years. What is the value, right? So that's how you do it, very quickly, simple concept. Again, do not try to remember this formula, because all you're trying to do is again the same thing. This was the original formula, 1 plus r raised to n. All you're trying to do, if you see out here, we're just removing that 1 and adding an exponential function out here, right? So mathematically that makes sense. Okay, so that's how, what I meant in terms of incremental compounding, right? So if you keep on increasing, right, so daily or minute, you'll realize that your future value is increasing. But I want you to think further, and this is an exercise that you can actually do, that beyond minutes, if you actually try to find out the future value or increase the compounding, you realize that the future value is actually dropping. Now that's something that you can discuss, and please do let me know what you feel